It has been a very, very full day. I hope you've had a chance to connect with a lot of your friends and colleagues and classmates. It has certainly been very exciting for us on this side. I get to see my own colleagues, Don Moore. I got to see that session. And, I actually don't get to see what goes on around here often enough, and it thrills me to get to see it. I'm not doing enough of that. It is my pleasure today to introduce to you a friend and colleague and somebody most all of you know, and that is Professor Ken Rosen. So Ken has really had a remarkable life and a remarkable career here at the Haas School and in many, many different parts of his life. He is chairman of our Fisher Center for Real Estate and Urban Economics, which has been a fixture in this area among all the schools. It really has distinguished itself, and for a long time. He has been a professor at our Haas School from 1978 to 2004. He was teaching graduate courses, as you know, in real estate finance, also real estate investment and economics. He was named our California State Chair of Real Estate and Urban Economics. That was 1986 that he became an endowed chairholder. And he kept that title until he stopped teaching. He has authored over 100 articles. He has 4 books on real estate and real estate finance to his credit over his career. Over his university life, outside of his university life, Ken serves as chairman of Rosen Consulting, a real estate market research firm, also chairman of Rosen Real Estate Securities. That is a REIT money manager, as many of you know. He received his PhD in economics from MIT, 1974, BA with highest honors from the University of Connecticut, 1970. He was a professor of economics at Princeton University, 1975, 1979. He is a trustee of the Urban Land Institute. He is also a member of the board of directors of several nonprofit and for-profit entities that deal with real estate, finance, and also development. Since 2006, Ken is and has served as the special real estate advisor to the Davos World Economic Forum. It is always a pleasure to hear Ken, hear his thoughts, hear his outlook, and I thank him for being here. Thank you, Ken.
Thank you, Rich, and welcome back to many people who were in my class 30 years ago. It's shocking. It's hard to believe. We were in Barrows Hall then, and we had these big posts, so you couldn't see the slides very easily, but it was a lot of fun. I really am glad to be back here at Haas. And I do run the Fisher Center here, so I haven't been teaching, but I do deal with many of you on our board. So what I'm going to do today is talk about the macroeconomic outlook. As you know, real estate is a function of where the economy is going. So I'm going to spend far more time on macro than you might want. I am the person between you and drinks and dinners, so I realize I have a limited amount of time. So I'm going to start with the positives and negatives on the economy. And as you know, the economy has been through a great recession, but has begun to recover. We have job growth in the private sector accelerating. We have very low interest rates still, and Chairman Bernanke reiterated again this week that's going to last for some time further. Very robust capital markets. Listening to the previous panel on dot-coms made me think, sounds like a bubble again. But capital markets are in a huge surge at the moment, and M&A activity is back. Corporate profits are at record highs, and emerging countries especially are growing rapidly. So everything is getting better, but we're starting from a base that's pretty low. We had a great recession, and we lost 8.8 million jobs. We've added back 1.5 million nationally, but it's a long way to go yet. And we've had a surge in commodity and oil prices, which worries me a lot, because that extra inflation adds to people's expenses of living. Their wages aren't going up as much, so they're going to have to cut back if this continues. And I do believe over the next 2 years, we're going to normalize monetary policy. What does that mean? Stop buying bonds in June, and short rates eventually will go back up to a level that I think would be 3%, 2-3%, not at 0. And the long bond 2 years from now probably goes from presently about 3.30 to 5.5%. That's the 10-year bond. So I think that's the likely scenario, but it's important. That's going to create some headwinds for the economy, but it's right where rates were in May of 2007. We do have the deficit problem nationally. I do not think that we'll be able to solve that as easily as some others do. We have state and local governments cutting back. We're losing employees every day at the local level. As you know, San Jose laid off 600 people last week. We have a crisis at that level of government. And we have still poor consumer credit availability. That is, if you want to buy a house, but you don't have a 700 FICO score and can't put down 20%, very tough to get a loan. So that's part of the reason the real estate market is not recovering more rapidly. So let me just go through some numbers quickly. Real GDP is the key measure that people look at. And as you know, we just got the first quarter numbers. The economy appears to have slowed some. It's probably a temporary effect due to weather and other components. We're estimating that the year as a whole will be 2.7%, but it started off slowly, slower than it was late last year. Jobs are what it's about for real estate and almost anything that you look at in the real estate space. And we've added considerable jobs back, about 100,000 a month last year. But look at the last few months, if you look at that box. Job growth is accelerating nationally again. We're adding more jobs more quickly, and technology, .com, social media, the Bay Area is sort of leading that back, Silicon Valley is leading that back, but those job creation fills space and creates a better real estate market. But it's important to put this in perspective. This shows you the percentage of jobs we lost in this recession, far left, 6.3% versus previous recessions since World War II. And most of the ones that you've lived through have lost 2 to 3% of our jobs. So this was double any other recession we've had since World War II in terms of job loss. And that's why this was a big emergency. 2008 and 2009, we were close as we've ever been to a Great Depression, financial sector meltdown. It was very exciting, but also frightening. And fortunately, that's over, but it's important to say there's still a big hangover. And the hangover shows an unemployment rate. The unemployment rate's 8.8%, going down, but it's got a long way to go. And the underemployment rate is about 15% nationally, and that means a lot of people have stopped looking for work, or they've gone back to school and dropped out of the labor force. And they're not counted as unemployed, but they would like to work full-time, might be working part-time. So this is why the Fed is still being very easy in its monetary policy, because there's a still large hangover of unemployed people out there. In terms of interest rates, it's an extraordinary policy we have. These are artificially low interest rates. And I can't emphasize this enough. There's a bubble here. The bubble on short rates, of course, is that 0.25% or less is just way too low compared to what will be in the long run. And so if you think they're going to stay low forever, wrong. And the 10-year bond, 3.3%, is also artificially low. My guess is that it will move up and down, but mainly up. And so both of these things say that no matter what type of financing you're doing, be aware that 2 years from now, these rates will be much higher. So it might be the time to lock in some longer-term financing, lock in your capital structure. Now, I am one of the very few people who believes this. Bill Gross believes this down at PIMCO, but a lot of people do not. Certainly the Federal Reserve does not think this is true. But I think that that is a call that it's hard to know for sure when it happens, but it's certainly going to happen. And the real rate of interest, which is these TIPS bonds, is 0.78, also artificially low. So you get this rate of interest plus a CPI adjustment each year. So the Fed has been buying these, holding down the real rate of interest. Normally, real rates of interest on a 10-year bond are 2 to 3%. So let's say it's 2 to 3%, and let's say we have a 3% inflation rate. That would mean a 10-year bond would be 5.5 to 6 once we normalize. So normalization is the theme I have for interest rates. It will affect real estate and housing markets, of course. And on the deficit side, there's a big dispute here between different parties and politics. I think it is true. We are living on borrowed time. The deficit should not be going up at this point in the business cycle, but it is. We cut taxes even further in December, and we have no control over what's going on in Washington. And I'm very worried that there's going to have to be a dramatic readjustment, both on the tax side. It's a sure thing we'll face higher taxes by 2013 or later, and of course on the spending side. Recovering economy will get rid of some of this, but we still have a structural problem, which I think is 4 or 5%. So there's a long way to go here, a lot of dispute. It will be the central theme of the election in 2012. How is the consumer reacting to all this? Well, as you know, the economy feels like it's recovering. But if you break down the consumer by income class, it's people in the higher income groups who feel very positive or more positive. The average American feels constrained by gasoline prices, real wages going down. You can see that the upper income is defined here by the Conference Board as over $50,000. We know that that's not upper income. I tried to get them, is there any further breakdown? They don't have it, unfortunately. And lastly, let me just mention a couple of more things. Our foreign trade imbalance is large. Our balance of payments deficit as a share of GDP has come down during the Great Recession, but it's starting to go up again. And I think this is something that we're just not confronting. I think there are two elements of it. One is our trade with China, and we outsource lots of our production to China, American companies doing this. We also, this number is about $300 billion a year, very large, half of the trade deficit, which is about $600 billion, balance of payments deficit. And the second component is energy, imported oil. And this is rising as the price of oil goes up. The volumes are actually going down slightly, but the price is going up. We have no consistent energy policy, despite the fact we have a great Berkeley/Stanford professor as head of the Department of Energy, Stephen Chu, brilliant person. He somehow has not been able to get Washington to have a national energy policy, and we need this. We need to get this number at a much lower level because we're importing this from our dear friends in Iran and Russia and Venezuela. It's a security issue. I got a chance to give this speech at a place down the road, a competitive school, and George Shultz was in the audience. And George said to me, this is the single biggest security issue we have. Forget about economic issue, it's a security issue. And as you know, oil keeps on going up. I have an old piece of data here. It closed at $113.93 on Friday. So this is up dramatically since the Middle East turmoil, about $30 a barrel since it started in January. And it's not sustainable at these levels. It's self-correcting, but it could go higher before it goes lower. And the one consequence of this very easy monetary policy and large deficits is the dollar continues to decline. And this, despite what Geithner and Bernanke said last week, we don't have a strong dollar policy. We have a weak dollar policy. It's low interest rates and our trade imbalance that are doing this. Clearly, if there's some big international upset, the dollar will rally again, but there's a structural decline that's happening here, and I don't think it's going to reverse anytime on a secular basis. Lastly, inflation. I'm using the words of the Fed. It's contained for the moment. The blip we've seen is transitory. Completely not true. But our good friends in Washington believe this. Clearly, the speculators in gold and oil and commodities don't believe it. The buyers of tips do not believe it. Our best guess is inflation over the next decade will average 4% a year, not 2% a year. That's a huge difference for the cost of nominal capital, and it's a huge difference for people's view of expenses and real income. Of course, 4% a year is still a very low number. You may have read the paper that was put out by the IMF. A friend of mine wrote it, said the optimal inflation is 4%, not 2%. And Janet Yellen, who's obviously a former Haas faculty member, about 2 weeks after that, before she was nominated for her president job, said that a little more inflation isn't a bad thing. So we're going to tolerate inflation as a way out of this. I think 4, we'll see where it comes out to be. And commodity prices are just part of this process. Inflation expectations in the financial markets, that is comparing tips and the long-term bond rate, is about 2.6%, so it's higher than the Fed would like. Recent polls indicate that people's inflation expectations are much higher. 6% is the recent one I saw. So this is the big worry the Fed has. If commodity price inflation, oil price inflation passes through the inflation expectations of consumers, they'll demand higher wages despite the fact we have unemployment rate that's high, and we'll start to see some pressures that they'll have no choice but to move. So our best guess for 2011 is that this moderate recovery we have will continue, and we might well see a double dip, but I don't think it's likely. It would require oil prices surging, consumers pulling back, or some other unexpected event. And again, just to summarize where we are in 2011, the most important thing to say is we think the short rate doesn't really move until the very end of the year, but the long bond, which the Fed does not control, starts moving up substantially. We add a lot of jobs, and the stock market seems to be okay with this moderate recovery scenario. Now, in real estate, we don't really care about just the national economy. We care about local economies. So this is a color-coded map of job creation year over year. And green is very strong job creation. The blue is good job creation. Yellow is modest growth. And we only have a couple of orange places which are still losing jobs. So what we see is one of the strongest places in the country is Texas. And we all know that they're taking California companies. Recently, a group of legislators and Gavin Newsom, our lieutenant governor, went to Texas to interview the California companies who left and find out why. Now, as you may remember, the unions were very upset about this. This is being a traitor doing this. You want to have an exit interview. You want to know what's going on. And clearly, there are lots of things they said that something can be done about. For example, it takes 7 years to get a factory approved in California through all these processes, 6 months in Texas. One of our most famous alums is building a big senior housing project in Pleasanton. Senior housing should be a no-brainer. It took him 6 years to get the land use approvals. We make it difficult to do things that we are going to let anyway happen. So I've suggested to Governor Brown that he appoint a jobs czar who will cut through the 200 permits and all this red tape and at least try to compete somewhat with our neighboring state of Texas. I say neighboring state because it is the biggest source of job loss is to Texas. Now, you can't really see this chart, so I won't don't look at it in detail. But just to tell you, the Texas metropolitan areas are growing most rapidly, but we have some stars in California. Silicon Valley, we heard from the group here. Silicon Valley is soaring back again. San Diego's bouncing back nicely. San Francisco, we're adding jobs, about a 10,000 annual rate, so that's a pretty good recovery. Silicon Valley is 20,000. And only one place is especially weak in Northern California, and that's Sacramento. I guess two places. Sacramento, understandably, we're cutting back, and of course, the East Bay, which is very heavily weighted to construction and government employment, is also weak. But California is coming back. In early May, the governor is going to announce the deficit is not as big as he thought. Instead of being $15 or $16 billion, which is the annual deficit, it might be as much as $6 billion less, because we are seeing a surge of tax revenues. He won't announce it, but the group that does this work announced it, I think, May 10th. So the recovery is helping tax revenues. Capital gains tax are up. All the previous panel you heard, people are making a lot of money again. And so that's helping California come back. We still have a structural problem, victim of the Great Recession. So now let me go to real estate. There's little new construction going on, and there will be very little new construction except for apartments. Demand is recovering, but slowly. Many people still have low interest rate loans, LIBOR loans. And LIBOR is very low because the short rate's low. So I call it LIBOR life support. When we pull that plug, we'll see some of that problem real estate come out. And there's very strong demand for hard assets. Just like gold is surging and commodities are surging, a lot of people, pension funds and others, want to buy hard assets. One of my consulting clients is the Texas Teachers Retirement Fund. They just bought a big chunk of gold, and we're working on a real estate program which they're also aggressively investing in. They're in the same basket. And real estate, even if it's yielding 4.5% or 5% compared to a 3.3 Treasury, looks pretty attractive. Now, I caution you, if you buy real estate at these aggressive prices, you've got to lock in your debt structure, because otherwise you'll face rising interest rates over the future. On the capital markets side, as Rich mentioned, I did a lot of work in the REIT area for 17 years. I fortunately am done doing that. It was great fun, made money for our investors and myself, and learned a lot. We've had an integral part of the class the last 15 years, a REIT game, and some of you won. Not only made money, but got a great bottle of wine. REITs are up again this year. Third year in a row, they're outpacing the S&P. But they've gotten very expensive. They're selling at a 16% premium to the private real estate. So if I buy $100 of REIT stock, I'm really only buying 84 cents of real estate. That seems pretty aggressive. But the stocks keep on going up because there's a surge of people looking for yield and looking for hard assets. And certainly real estate in the public format is in that situation. There's something called cap rates. Any of you in the class remember that, I'm sure. It's the inverse of a PE. So cap rates have come down, which means PEs have soared. PEs are 25 today in the public market. That is really high for modest growth. These don't have big growth. They have modest growth coming. Also, the debt market is coming back. Over the years, we've had some of our graduates of our program been the leaders in producing mortgage-backed securities on Wall Street. At the peak, we did $220 billion a year. Major part of profits of Wall Street firms, major part of the downfall of Lehman Brothers was their mortgage-backed securities program, holding them on their books. Last 4 years, there have been very little activity, but it's now picking up again, and it's commercial real estate securitization 2.0, a little bit more conservative, but I'm afraid that we might make the same mistakes again. We're very good at doing this in financial service industry. In terms of construction, we have the lowest level of office construction in 50 years. And demand is coming back quite strongly in some of the markets. And vacancy rates are starting to come down. So the markets are improving a little more slowly than you might expect because many companies are using shared office space. People are not necessarily working in office. So all the technology we heard about earlier today, you don't need as much space per person. So it's going to be a slower recovery than in previous cycles. And rents are flat after dropping about 25%. Now, what many of you might be concerned about or excited about is residential real estate, for sale housing. You think it would be doing great. Affordability is the best we've had in 50 years. Low interest rates and price declines mean a lot of people could buy a house. But the credit is so tough to get today. And it's all the same government regulators who would not deal with the 2007 credit bubble, didn't believe there was a bubble. Janet Yellen was very kind. I presented to the Federal Reserve, and she agreed with me, but couldn't convince the other people in Washington. Mr. Greenspan in particular didn't believe there's such thing as a housing bubble. If anyone has made the mistake and didn't do the regulations, it was him. They had a great set of proposals put forth to the Fed, and Greenspan himself vetoed it. I read the internal paper. They knew exactly what was going on, knew it should have been regulated, but they didn't do it. Now, they've made the regulations so tight that one of our former professors is now head of risk management at Citibank in the real estate area, and now's the best time to be aggressive at lending for single-family housing at the bottom of the market and fully underwritten, of course. He said, can't do it, can't do it. The regulators won't let us. So the regulators, on one hand, the Fed is pouring money into the system. The regulators saying, but you can't lend it to anyone who wants to buy a house. Complete incompetence. It's shocking. Having been tried very hard, I actually got invited to the meeting where they discussed this. Geithner had a meeting, and hard to get in, but I got into the meeting, and of course they wished I wasn't there. But they're just doing the wrong thing. And yet someone like Janet knows it and tries her best, but controlling this stuff is pretty tough. Prices are bottoming, but there's still lots of foreclosures out there. And a professor from Yale, who is a classmate of mine at MIT, Bob Schiller, thinks there's going to be another 10 to 20% decline in prices. He and I debated at Davos, and he's completely wrong, but he thinks it. And it's important that everyone know that because he has the index they all look at. I think prices have bottomed already. And unless we go back into another recession or they pour all these foreclosures on the market at the same time, I think that's over. So, and credit can't get any tighter. They're going to figure out that they're making a mistake. There are some sectors doing great. The apartment sector in particular, I'm going to show you that in a second, and senior housing. For all of us retired professors, there's going to be 80 million more retired people joining them in the next 20 years. And most of them will live where they are now, but at least 15% will move and want something different. So senior housing is going to be very strong, as is the apartment sector. Single family, very slow recovery. You can see the single family starts, very slow recovery. Big inventory of unsold houses still. And if you look around Oakland, Berkeley, you'll see there's quite a bit of for sale signs. People haven't yet realized they have to lower their price more. So that's part of the reason we have the inventory. And there's still lots of foreclosures going on. So big numbers still. We haven't resolved this issue. California's been better, but especially in Southern California and the outskirts of the Bay Area, a lot of foreclosures. And house prices have actually started going up. House prices went up last year, despite what Bob Shiller said. This is a different data series, up 2.6. I think they're going to be up again this year. And affordability is great. If it wasn't for the tight credit and for the high unemployment rate and for the uncertainty in the world, we would have a booming housing market. But if you look at Canada, Canada often leads us in housing, Toronto especially. Their housing market in the last 6 months has really turned around. Prices are up 9%, and it's quickly moved in that direction. Hong Kong, as many of you know, is up 20 or 30% each for the last couple of years. So it's surging everywhere except the bubble places like Ireland, Spain, obviously ourselves, and UK. The problem and the risk here is mortgage rates. Mortgage rates move in line with treasuries. If I'm right about the 10-year treasury moving up from 3.3 to, let's say, 5.5, that would push mortgage rates from about 5 today back to close to 7, 6.5 or 7, and that would be a big headwind. So that is a worry that is real and could stall the recovery. Also, a dramatic shift. A lot less people are deciding to be homeowners today. 69.2% were homeowners in 2005. That's dropped to 66.5%. Partly tight credit, partly foreclosures, partly people no longer think of houses as going up in value. So they're not buying as many people are deciding to buy houses. So let me just give you our favorite sector, which is multifamily rental. We're going to see a boom in construction, up 37% this year. And vacancy rates are plunging. People aren't buying, they're renting. Much of it by choice, but some by necessity. And the yellow line here shows that recent college graduates are really having a huge surge in job creation. It is a boom again. We heard some of that earlier. And if you're over 50, it's much harder to get a job back again. And so who occupies apartments? People under 35. And household formations are going up, and rents, the orange line there, is also going up again. Just to show you this chart, almost everywhere rents and occupancies are improving. San Francisco up 9.7% year over year. That's a huge increase in income in 1 year. Boston up 9.6, DC up 7.9, highlight a few places. Southern California is much slower, up 2 to 4%, and Las Vegas is still losing. Many of you took my class, and 31 years ago I told you Las Vegas was a bubble. I said that each year for the last 31 years, and it did finally happen. So timing is everything. Overbuilt dramatically in housing, overbuilt in gaming. Gaming spread everywhere now, and I do not think Las Vegas is going to come back strongly in the way it has in previous cycles. Returns on apartments, last year 18%, already for the first quarter of this year annualized 13%. So we like apartments, except the pricing is very rich. So you have to have a lot of rent increase, which we're getting, but the question is, will we have enough? And I think this is the key demographic we look at, the population turning age 18. It's the echo baby boom. And you can see the numbers were very strong in the 70s. Many of you were part of that demographic. And now they're really strong for the next decade. 1 million more per year than we had 20 years ago. So very strong demographics. And also the aging population, the red line. 12.5% of our population is over 65 now. By 2030, it goes to nearly 20%. So very strong demand for senior housing. And one of our most successful graduates, I can give his name, Ned Speaker, of our program, that's what he was a leading office building developer, sold the company to Sam Zell at the peak of the market, Speaker Properties. All he's doing is senior housing. He's on his fourth huge $300 million project in Pleasanton. And immigration, it's something we should embrace. And we're going to see, we think, 1.2 million a year or 12 million new immigrants over the decade. Half of the population growth in California comes from international migration. Very big positive for Silicon Valley and the state as a whole. Only one negative. The divorce rate's declining. Any of you in real estate know this is a bad thing. Encourage this among your friends and neighbors. You've probably had done this since you've been gone for a long time yourself a couple of times. But the ratio of households to population rises more slowly if people stay married. So if they break up, 1 out of 2 goes and sets up a separate housing unit. So we encourage this from a real estate point of view. Next, retail space. I know a number of you work in that space. So the thing to say here, for all real estate except for apartments, the lowest level of construction in 50 years. So very little construction. Demand's coming back. We're surprised that retail has recovered so well, especially at the high end. And vacancy rates never got really high here. Again, a surprise to me, but what it is that people had pent-up demand. They didn't buy in the end of 2008, early 2009, but they just couldn't help themselves. Those necessities, jewels and all these other things are absolutely necessities. So Tiffany's and high-end just booming. And we didn't have a lot of store closings. I thought we would have seen a lot, but it was up a little bit in 2008, but basically very mild recession in retail. And retail is a cannibalistic industry. That is, the warehouse clubs and superstores, that yellow line, have been eating alive the department stores and the grocery stores. And the dotted line, the internet, also continues to rise. Many of the next generation live online, buy online, and that is certainly a rising trend. Less need for retail real estate relative to the size of the sales levels. Returns have been really good the last couple of years because after apartments, it's the second best sector in real estate. Hotels, we built too many hotels. There was a bubble just in single-family housing, also in hotels. But finally, we're getting back. Occupancy plunged during the Great Recession. It was actually lower occupancy than after 9/11. And we've had a surge in occupancy, a surge in revenue per available room. And you can see the high end here, luxury end, has shown the biggest increase, year over year, 13 to 15% increase, very strong. Luxury is back, and it's showing up in financial markets. It's showing up, obviously, in the hotel industry. And returns have been decent here, but not great, because we're still not at full utilization of the hotel units. Lastly, warehouses. Many of you don't think of them as real estate, but they are. Lowest level of construction in 50 years. We are seeing some increase, substantial increase in what is called the 20 equivalent units. These are these big containers, and we're seeing more of those happen again. World trade volume is back to past its previous peak, and especially strong in Southern California. Trade from China coming back in again. Vacancy rates are beginning to come down, and returns have got back to the low double digits. So let me close by saying it's a very interesting time to look at real estate. Core real estate is a place to put your money, but the yields have to be going in, I'd say, 5 to 7%. Hard to get that in the Bay Area. I want to buy below what it costs to build a new building, 80%, maybe 20% below what it costs to build a new building. And especially some of the niche product types like senior housing and medical office could be quite interesting. I'd still be somewhat defensive. I would not go to very high leverage levels, maybe 60 or 70%. And if you want to hedge yourself, you can short treasuries. I would also say the high-end Chinese real estate market is in the biggest bubble, much bigger than we had. They've got huge numbers of empty units, own 3 or 4 apiece, and the government is trying to slow the inflation, stop the inflation, and they will be successful, in my opinion. If you have more risk profile, you could buy hotels at 50% of replacement cost. The Claremont Hotel here in Berkeley has gone bankrupt and probably is available to be purchased, and it's over-leveraged. That's what happened. The group that controls it now is Paulson, the hedge fund manager out of New York. I went to see him and tried to convince him to let me put a group together to buy it. And of course, he wants the old price. Not going to happen. I'd also buy vacancy. I'd buy buy buildings that have a lot of vacancy because rents are going up, occupancies are improving, and you don't have to pay as much because you don't pay full value for that type of space. And apartments, again, my number one favorite place to look today. So at this point, I'm going to stop. Most of you realize that was 2 lectures. Who took my class, I did talk a little faster than normal. But I had a professor at MIT. His name was Franco Modigliani, and he won the Nobel Prize. He talked 5 times faster than me. You had 10 notebooks for his class versus 1 in any other class. So I learned from him. So I'd be delighted to take questions. I think we have about 15 minutes before cocktails. And if it's like the BA 280 class I used to teach, we never had enough time. So I hope you've got lots of good questions. And thank you for sticking around. I'm amazed that so many people stayed to the end of the day. Yes.
So going back to jobs and the importance and the implication for the real estate market, you talk about contrasting California to Texas. What about the United States compared to jobs going to India and China?
So huge job growth, obviously, in both India and China and Brazil, a lot of the BRIC countries. We added 1 billion people to the world labor force when the internet became such a way to do white-collar business other than just manufacturing going abroad. The problem in a place like China is it's so easy to build. The government's your partner. Who sells you the land? The local government. That's how they get half the revenue. So investing overseas to take advantage of job creation doesn't work if you build too much. Texas is a perfect case in point. Texas has had a lot of job growth for a long time. But to make money in Texas real estate's been very tough. You have to get in and out at the right time because they constantly overbuild. So I think job growth in a supply-constrained market like San Francisco, Silicon Valley, Berkeley is great. It produces increase in real estate values, or New York. It doesn't do it in, I think, some of these other places. Now, China, I must say, and Hong Kong is having huge surge in real estate prices. Part of the reason is interest rates are actually negative. They're tied because their currency is not floating very much or just a little bit upward. They're tied to our interest rates. So our easy money is spreading to these markets and has produced the boom in real estate values. I did papers a number of times in Hong Kong, and these cycles are hugely exaggerated in price, and then they burst. I think it's going to happen again. When you hear the Chinese premier or the German prime minister all talk about yell at the U.S., and Bernanke said, no, there's no way we could be influencing what's going on there. It's just not true. The global linkages and flows of money are enormous, and that's why the money is flowing to a lot of these places. Brazil's put exchange controls on because people are searching for yield, and yield is higher there, and it's created a huge bubble in property in China. India, the bubble is already deflating a little bit at this moment. They've been raising interest rates substantially.
Given the huge deficit, what's the likelihood that they'll cut the mortgage interest tax deduction? And if they do, what will be the effect?
So the mortgage interest tax deduction, right now you can deduct interest in up to $1 million of mortgages for personal residence, first or second homes together. I think it's highly likely that that'll be on the table in the tax reform plan. Both tax reform, there were commissions that one Obama nominated, one they put together themselves, certainly talked about reducing, if not eliminating that, or making a tax credit. The Obama administration, in their own discussion of housing policy, and Fannie and Freddie have said the same thing. Any of you who are in the high income tax bracket realize you can't take the deduction anyway. And AMT and other things, you just don't get much of it. But my guess is a very high likelihood that it'll be cut, probably not eliminated, but cut substantially and probably turned to a tax credit, which makes it more progressive. So I think there's a big lobby, the real estate lobby, housing lobby, but they are not in favor in Washington now. After the housing bust and the loss in Fannie and Freddie, they're having a lot of trouble getting anyone to listen to them. I don't think any of this happens until 2013, and when it does happen, it'll probably be phased out over 5 years, some period of time like that. It's possible we could get it faster, might go to a flat tax and eliminate all these deductions, and there are some very smart people who think that's the way we might go. So, as a professor, I've written a paper on this. I actually wrote a paper with someone on Bush's economic council, Harvey Rosen, no relation. We found that it would reduce the home ownership rate by about 1 or 2 percentage points, depending on how it's done, and we reduce prices by 14% at the upper end of the marketplace. So it would have a big impact, but that was done a decade and a half ago, so we probably should update it. I'm sure the Association of Realtors will ask me to write that paper, but I have to be objective, and they don't always like that. Yes?
Sorry, I just had a quick question about the, position we are in the current business cycle. Do you think we've reached the point of consolidation or about to reach it? And if not, what's your take on how that consolidation with M&A activity might affect the occupancy rates in real estate?
Yeah, so I think we're early on in the business cycle. I'd say if you think of a 9-inning game, probably in the second or third inning. If you look at the last cycle, it started big crisis in 91, 92. So we're probably in 1995, and the peak was 3 or 4 years later. So I think we got a ways to run here. The oil price surge and commodity price surge is certainly one negative, but the Fed is going to try to let this run longer to get more job creation. So I think we have a ways to run yet. It usually happens after an election, so after 2012. 2013, if I was going to guess when might be the next down year based on political economic dynamics, that might be the year they try to both tighten monetary policy and fiscal policy, wait to the election. That isn't very far away. It's shocking. But it could happen sooner. Something could cause a crisis. When they mentioned that S&P might downgrade the U.S., there is that debt crisis possibility. Oil prices surging from 114 today to 150 because of something in the Middle East, again, a possibility. So there's a lot of risk out there. But the internal dynamics of the business cycle, I think we're still at a pretty early stage, and I think we can bubble for a while, a considerable while longer yet. Yes?
Is there any trend going on with home loan modifications versus foreclosures currently?
As you know, it's and some of you may have seen me on CNBC. I've been on there 30 times. It's an absolute tragedy what has happened in the attempt to change the foreclosure profile. We knew that we needed massive modification program. And the previous administration and this administration has basically been unsuccessful at getting anything to work. Part of the problem is about half the people who need a modification wouldn't qualify for the loan today. They lied on their income statement. They just shouldn't be a owner. But the other half, you call and you can't get an answer. My bank friends are overwhelmed. They don't have enough resources. They haven't put enough resources into the modification process. And also, if the true write-off had to be taken, in other words, if we wrote down people's principal balances, we have a moral hazard problem. Who do we give it to? Almost everyone in Las Vegas would need it. In the Central Valley of California, most everyone. Even people here in the Berkeley and Oakland Hills need it. So it's very complicated, but we've not had a point person. We have no one who's in charge. And so they have rounds of meetings, and nothing happens. Recently, I think we're starting to move in the direction of more aggressively doing something, but I still think it's going to take 2 more years, and half the people are going to actually lose their houses. What we could do, though, is increase demand for housing by making credit more available to people who want to buy. 40% of the people trying to buy today get turned down for the home loan. So if we made it easier at the bottom of the cycle for those people to buy, that would increase demand, firm up prices more, and reduce the cost to the government and the banks. So that's an easy solution, which, since there's nobody in charge in Washington at all, if there was someone to talk to and get it done, it'd be great, but there's no one on a housing policy, at least, in charge, or mortgage policy. There's nobody there. No one to even talk to, tell us to. You tell it to Janet Yellen, she's wonderful, but this isn't what she does. So that's the sad part. So I don't think a big change. And I think we'll bleed it out over the next 2 or 3 years. It won't be all done all at once. Yes?
With the 2011, 2012, and perhaps 2013 position to have the highest foreclosure rates in property in single-family residential, and rates positioned to go up. They have to go up at some point, like you mentioned. What does that bode for the housing? You know, I would say in the next 3 to 5 years, we have tons of short sales and other challenges, and then rates having to go up. What does that do to the housing and economy?
Right. So it's important to distinguish locations. So in San Francisco, Berkeley, Oakland, just forget. It's not an issue. It's not going to happen. We don't have that issue here. But if you're in the Central Valley, I think we have the issue you said. We could see prices go down lower because we don't have the demand. We have lots of inventory. In Las Vegas, Arizona, Florida. But in Washington, D.C., don't have the excess inventory. New York City, we don't have it. So it just depends on location. And it's hard to craft a policy that's geographically specific. So I do not believe that we're going to see another double-dip leg down, but I must tell you, I'm in the minority. Bob Schiller really thinks this is going to happen. I'd say a woman by the name of Ivy Zellman, who's the leading analyst, Wall Street analyst on housing, thinks it's going to happen. So there is a chance it could go wrong. I don't think it's most likely. I think we're more than halfway through the foreclosure issue, and in places in California, urban California, it's really not an issue any longer. There will be individuals who have this problem. So I don't think it's an issue, systemic issue. I think it's already happened, but it's going to be a struggle, and if interest rates moved out quickly, it could be a bigger issue.
The follow-up was, do you think the government will replan to step back in just as they have done with QE2?
I would think that the government would realize that housing is not a function of what they're doing. They've basically giving away money, it's not made a difference. If they would change credit standards, then it would be a different story. So I would hope there wouldn't be based on housing. Bernanke, who's a very bright guy, I know him, said in his statement at the news conference, he was surprised that residential and non-residential construction was so weak in the first quarter. There's no surprise. It's going down, not up, because we have the inventories on both sides to get over. So every economic model and forecaster is talking about non-residential construction surging in 2012, 11 and 12. It isn't going to happen except for apartments. It just isn't, because we have enough vacancy for a while. So they don't get the dynamics of the micro markets as well. So I don't think they'll change policy based on housing. They'll look at I think employment is the number one thing, and obviously inflation and inflation expectations. I can't, even though I know half of them personally, first of all, they can't tell you what they're going to do, and it's hard to know. I did take one of the members and played 18 holes of golf at the San Francisco Golf Club. And when you play golf, you learn a lot. So, but he's on the hawkish side. Janet's on this side, and he's on the other side. So what he wants to happen probably doesn't happen either.
To what extent can the private sector in California continue to prosper given the fiscal irresponsibility coming out of Sacramento?
Well, that's a great question, because we have a new governor who is an old governor, who's a very good friend of ours, and we helped him a lot. I think if anyone can get the unions and others and the Republicans to make California great again, it's Jerry Brown. But he's not had very much success so far. We have to all work together. So I think the progressive business community has to lead this effort, Republicans and Democrats. The proposition system is one of the main problems. I first moved here and taught here in 1979, and we had just passed Proposition 13. And I wrote a book that said, this is going to create a crisis, because and the book was published in '82, because you're taking sucking all this money out of the local governments, going to the state, and then reallocating it back. At the time, we had a big surplus, so it wasn't an issue. But now it's a big issue. We've gone from third in the country on education expenditures per capita, K through 12, to 47th. We put in all these propositions which regulate so many different things that make it very difficult to do business here. So the number one priority, and we've had Jerry at meetings and our meetings, and he understands this, but I think he feels he's got to deal with the budget issue first. Then secondly, he'll work on the job creation side. Because if we don't do the job creation for the private sector and they move to Florida, or, I'm sorry, not Florida, they would never go to Florida, because you have to live there, but Texas, Nevada, Texas is good, or China. I think we have if we don't create the private sector jobs, we can't create the income to pay the taxes, to support the university and all the great things we need to do. So he knows this. I'm very hopeful in the next few weeks he might appoint a job czar who would really look at this as the number one issue. How do we cut through all the difficulties that we have? So thank you very much, and thank you, Rich.
impact on so many lives of the people in this room, many of the lives of people who aren't in this room, our own classmates for so many decades. Thank you for that, and thank you for that wonderful talk. Let me conclude, and then we will hopefully see many of you at dinner. I know not all of you can make it to dinner. Our school star is rising. It's rising because our alumni network is so strong. It's rising because deans who came before me put us in a wonderful position. It continues to rise. You've heard me talk about doing everything I can do, and all of us here doing everything we can do to keep that star rising, and I promise you we're just deeply committed to that. I need 3 things from you, though. I'm going to ask you for 3 things. Number 1, hire Haas. Hire Haas. We need you to reach back into the talent, and many of you already do this. You're involved in organizations. Have you activated the school team in your organization? Many of you have been away for a long time. Great business schools do lean into their own, and we need to continue leaning into our own. I promise you the talent is just as good as you can find anywhere. I promise you that. Number 2, we also need you to stay connected more generally to this school, right? Come back and audit a class. Come give a lecture. Do some coaching, right? Whatever it happens to be. There are so many more ways for you to stay engaged now than there used to be. Let's find the way that works for you, because you're all very, very busy. But we have a lot of ways that can work for you, okay? So stay engaged. Number 3, keep investing in your business school. It's absolutely essential. It's absolutely essential. Our annual fund is $3 million a year. If our annual fund were $1.5 million, I promise you our star would not be rising the way it is. And if it were $4 million, I promise you we'd be surging forward that much faster. The state of California effectively, net in resource terms, covers 0 of our budget today. So it's a new funding model. It's a new world. We are able to compete, but we really need you to keep investing. It's absolutely fundamental. So the annual fund, the Haas Fund, continues to accumulate in our campaign for Haas. We're in the middle of a capital campaign. We're making lots of investments in new facilities and new programming. We need you to keep investing, okay? So let's keep this place rolling just the way it's been rolling for so long now. I have only to conclude. So let me conclude with a big, bold, go Bears, and we'll all have fun tonight, okay? Thanks for coming tonight. Thank you. Thanks for coming.